a real estate bubble. We're in a money bubble. We're in a debt bubble.
Right.
Everything seemed to be in a bubble. Stock was even in a bubble. So if everything was in a bubble and the economy crashed, these financial gurus, they kept on saying, you want to be on the right side of that so that when the wealth transfers, you're on the receiving end
of it, not
right?
the giving end.
And I always wondered, what is that? Because if everything is in a bubble, where do you go? And that puzzled me for a while, because if I was in real estate, should I go to stock?
Well, hello, Steve.
Hey, Steve.
Welcome, folks, to the Steve and Steve Show. I'm a little tired today. I don't know why.
Probably because it's been a long day. Lots of activities.
Maybe that's it. But thoroughly excited to talk to you and all of these folks out here listening.
Yeah. So thank you for finding us, discovering us, pushing play, and listening to us. Certainly appreciate it. This is the first time you've found us. Do us a favor and hit that subscribe button. That certainly helps us out in a big way. And if you have watched us before and you haven't hit subscribe yet,
what are you waiting for?
That's right. And then add comments and likes certainly helps us in the bigger picture.
Tell all your friends and family and everybody else you know. And we really do appreciate y'all for showing up here for these 15 or so minutes.
Yeah.
So we got a really good one today, I think. How do you make money? Yeah. What is it again?
The topic is the different ways you can make money in the stock market.
In the stock market. And I've had a little bit of experience in that since I wrote a book on it, right?
Yeah.
You should have said that so that I didn't say that. But
yeah, well,
this is raw, by the way, remember. The Steve and Steve Show is raw.
Yep. So if you're looking for a good strategy to invest in the stock market, a really good book that's my friend here, Steve, wrote. It's called Trading on the House, and you can get that at tradingonthehouse.com or on Amazon.
You can, both places.
Yeah.
And all of our people, I'll sign it for you if you really want. But so let's talk about the stock market. Of course, I think that would it be a fair statement to say that the majority of the people that are thinking about the stock market tend to think of it in their retirement accounts or 401ks, IRAs, things like that. Would you say that's a fair statement?
I think that's a fair statement of how most people are involved in the stock market.
So it's a long-term strategy. I'm putting in every single month, maybe.
Yeah, and so I would say that's a passive activity.
Very passive.
So that comes, they set up with their employer. It gets put in there. They might have some choices of where it goes. They might be in a mutual fund, which if you're not familiar with mutual fund, it's a way of pooling many investors' money together, so they have a buying power, and you can go buy individual stocks out of that.
But they're not, the investor, like you or I, wouldn't be buying those individual stocks. They're buying the Jones Granson Mutual Fund.
Right, so there's a manager of that fund that actually does the buying. But they have many stocks and many companies, and sometimes they have a focus. So let's not get too much into the details of that, but let's talk about what's the most obvious way someone can make money in stock.
Well, I think probably the most obvious would be to go out and say buy some shares in IBM or Microsoft or Tesla.
Okay, so they're buying shares and they buy it, but then what do they have to do to actually make money?
So the typical way that someone's going to make money in the stock market when they're buying stock is you buy low and you sell high.
Okay.
I mean, that's the idea.
Simple.
If I can get in here at some low price, hopefully I'll get out of here at some higher price. Sounds simple.
Yep. Long term, right?
Yeah.
Long term, that works. So the idea there is that there's appreciation or a gain. Is there another way?
Before we get to that, I mean, within that strategy, a lot of times what people will do is, let's face it, it's impossible to predict the market, right? Mm-hmm. I mean, we're in the midst of a bunch of things in this whole pandemic stuff, and the market has crashed, it's gone back up, it's crashed again. So it's really hard to predict, and we've gone through those. If you looked at it over the last 30 years, over the last 100 years, you'd see a lot of the ups and downs. Tough to predict. So for example, what I've kind of said to do is, what if we were to do something more like I go in there and I'll buy a stock and I'll sell it out when it reaches some sort of a higher price. I'll take my investment out and then I'll keep that stock and let it run for the long term. That's another way of looking at it.
It's a strategy within
Within
that same
stocks.
thing, right? So you're still seeing that you're buying at a certain price and I don't want to say hope, but basically it is kind of a hope that it rises in value, right?
So the direction is
upward, right?
Upward.
So, but there's another strategy where you buy the stock and you hold on to it, but you still make money on the way as you go, right? On a quarterly
there is.
basis.
He's trying to tease something out of me. I think it begins with D.
Yes.
Dividends.
Dividends.
All right. So what is a dividend, Steve?
So a dividend is you're probably better to explain this, but it's when the company has earnings and they look at how much they have and they say, you know what, we can actually give back to our stockholders.
Yeah.
And so
this is in the public market, right? These are
Right.
publicly traded companies that all of you can participate in.
So they declare the dividends, and it might be I don't know, 10 cents a share, it might be a quarter, it could be
Right.
a couple dollars a share, depending on the different stock. So there's people out there that have, 50,000, 100,000 shares of stock, and they get the dividend quarterly. And so they actually have money that comes in on a quarterly or a monthly basis, whatever that
Right.
rhythm that is for that company. So they get that check that comes in. So that's another way.
It's
of
a
making
great
money.
way, actually, if you can find some of these dividend stocks in a market that's trending, for that stock trending up, you can get those dividends, like you said, on a quarterly basis. Sometimes they'll cut those off. If their profitability doesn't get there, they might cut those off.
Right. Or hold them, right?
Or hold them back, that
Yeah.
is. But yeah, no, dividends are a dynamite way to do it.
Yeah.
Well, so there's another way, Steve, though, that because we can't predict if the market's going to go up or the market's going to go down, wouldn't it be nice? That sounds like a song. Wouldn't it be nice if you could do some way of participating in the market where you could win if it were going up, if it were going down, or if it were going sideways? Wouldn't that be just like the cat's meow?
Yeah. So you've heard the different gurus out there say that that's what they do. They make money when the market goes up, down, or sideways.
How the heck do they do that, and how can I get involved in it?
Well, you got to get some education.
Okay.
So financial education is a key.
And oh, by the way, this is information. We're not financial advisors here. If we talk about a stock or a strategy, you're getting it as information. Please don't think of it as we're giving you financial advice per se.
Yeah.
Had to say that for the lawyers.
So
What are those called anyway?
it's basically options.
Options trading. Have any of you folks heard of options trading? Or maybe you've heard of it as called derivatives, which are a lot more than just options, but derivatives are not the actual stock per se, but an actual contract on that stock.
Right.
You want to explain that?
That's a lot. So
Real quick. We're not going to.
So basically, you basically have you're buying a contract to purchase the stock, the actual stock, later, if you choose.
Okay.
But the actual transaction is actually buying the contract that gives you the right or the obligation to do something with the stock. Either you're buying the stock or selling the stock if you have it. So it's the option is on top of or side of it, but it's the contract that gets you to that. So kind of like a first right or refusal type of contract.
Okay. I think we've used the example of real estate, and people might understand that where when you go in to buy a house, oftentimes you're going to put down money on it for a period, let's say of 45 days, an earnest money deposit. And that might be a $10,000 deposit that says, all right, I have the opportunity to get this house within this certain amount of time. Similar, and then if you decide that you're going to do it, you pay for the house and you get it. Similar, not exactly, but similar.
Similar because I'll say similar because it's what you do is there is a contract in place, and the contract is to execute on the purchase or to sell, depending on the side of the table you're on, of that property. And you have due diligence time, and during that due diligence time, you really have the option to, like, if you find something that you don't like, you can get out, right? Or
Yeah.
if you don't qualify, you can get out. But there's really an intent to make the purchase with
Right.
that. Now, in real estate, there are options in real estate. The lease to option lease, you rent to own type situation where you get an option on a house, you rent it, and down the road, a year or 2 years, you have an option to purchase the property at a certain price. So
We
it's-
should do something on real estate.
Well, we probably will.
Yeah, why don't
So-
we do that?
But it's the same way with stock, as you have that option to purchase it or to sell it later. So when they talk about you can make money going up, so you buy an option at the price at one level, and as it goes up, you may opt to sell that contract to someone else who likes the new price. Same with if it's going down, there's a way to do options so that as the market goes down, you can actually predict that it's going to go down and buy that trend going down. So you have an option to pick up stock in a little bit different way.
Yes, okay, so I'm gonna dig in just a little deeper, not a lot.
Okay.
But I trade these options every single day. And so I think the thing to really think about is you've got the stock here, and then you've got a contract that lets you control that stock, and they do it in hundreds share levels. So one contract equals 100 shares. And the key thing to think about that is, let's say we look at Tesla right now, and if you've been looking at it at all, it's around $1,600 a share. Well, if you wanted to buy 100 shares of Tesla, that's going to cost you $160,000, right? How many of us can just go out tomorrow and say, yeah, I'm going to go buy 100 shares of Tesla? Most of us aren't going to run and do that. But in options trading, you can actually buy you can buy one contract which gives you control of 100 shares, and it gives you the right, when you buy it, to actually execute one day and say, I want to get those those 100 shares at this certain strike price. So if the price today is 1,600 and you do what's called a call option, which is going to go up, you would maybe buy a call option at $1,800. And for a certain amount of time, and if that stock goes up to $2,500, you control those 100 shares at $1,800. So you can see where that would be. A, the contract itself is going to be more valuable because somebody may want to get that,
Right.
and B, you may decide, I want to pay $180,000 because my stock is worth $250,000 because it's at $25.
Right.
That's kind of a quick thing.
So if you look at it, you have really two markets going on, but they're tied together, right? So you have the actual stock, and then you have the contract or the option, right? And as they both go up and down, instead of actually trading the stock, people trade the options.
That contract.
Right? So they're buying and selling options just as if they were to buy and sell a stock. The option is tied, so there's something there that you can see where the value is, right? And the only thing here is the stock. You own the stock if you buy it, and it's yours forever. On the option side of the contract, there's a limited time.
It expires.
Yeah, there's a limited
Right.
time for that contract to be valid. But they get traded in that same amount of time.
They do. And that is why actually they call them derivatives, because the underlying thing is the stock, and the derivative of that stock is the option.
Right.
Or there's other things called futures, and there's things you do with currency as well that are
Right.
kind of derivative like.
So
But with that, let's say, so we talked about a call. A call option is where it's going up. A put option is where the market's going down. And just like that scenario we gave you with Tesla, you can actually make money on a put option because you think Tesla's going to go down. So instead of it being where it's at $1,600 today, you think it's going to be at $1,400. You could buy a put option for, say, 30-day expiration, and if in that time frame the thing drops down, the same things happen as it was going up, but you actually can get money because it went down lower than what you said.
right.
But you also said, Steve, that you could make money going sideways. What the
Yeah.
heck
Yeah.
does that mean?
So when there's stocks that just kind of go this way, they don't really go up, they really don't go down, but they just they're steady.
They're going
They
sideways.
just always go in this like a little bit of a channel. And
What
there's
do you
a
mean
way
when you say channel? What do you mean? Is
that they don't really go up above a certain
so there's a high
price
point of the channel and
and a low point,
Ah,
and they just kind
gotcha.
of the price just hangs out in that little bit of an area, and so the stock goes sideways. And so call and puts are the basics of options, right? And this is the part where stock or option trading gets risky. And what you really need to do is study, learn it, get educated on the different things, because there's a whole bunch of different things you can do. But there's a way to set up a trade so that as long as that stock stays in that channel, you get paid. If it goes above that channel or goes below that channel, then you lose, right?
Right.
So
within that time frame that we're
within
talking
the time frame,
Got
yeah.
it.
So, but as long as it stays in, that's how they get paid sideways. So and
Pretty neat.
if you do it right, you could actually set up where it kicks what they call cash flow, right? Because some of their stocks, no matter what happens in the world, they just kind of
Hang in that channel.
kind of chug away.
Kind of boring.
Kind of boring,
But those boring
you can
ones, you
make
can
money
make
out
some
of
money
those.
off them.
That's
Okay,
right.
so this is all very good, but as Steve mentioned something there about risk, while options are really intriguing, there is some risk in it, and we highly recommend, well, in both stocks and options, we highly recommend getting out there and doing some learning on it. There's a great resource on options by a gentleman named Tom Sosanoff. He started a company called Tasty Trades. And I'll tell you what, that's some of the best education, and a ton of it is free at tastytrade.com. So I'd recommend heading out there to that one.
Yeah, and that's
checking that out.
not a paid endorsement.
That isn't, no, we have nothing to do with it. I
It's
happen
something
to,
he
the guy-
really likes the site,
and the guy is a
the guy's-
fantastic, he's a genius in options.
Yeah.
There's Investopedia is a great site to go to check out
There's-
just general ideas of the stock market.
And they can go to like some of the bigger ones too, and they have online training courses that they can do. There's tons of books.
In the exchanges,
lots of different things. So
I just want to give a few resources.
So
We're
one
going
of
to put those in the thing.
Yeah, so one of the things definitely did not like stocks, trading stocks, because when I was younger, I did some trading and didn't do very well. I have always been in real estate, and I'm a real estate investor,
Yep.
and so it was tough for me to switch over to stocks because, in my view, there's a lot of factors that go on stocks. There's political, there's economical stuff. There's your competition can affect your stock.
There's disasters.
There's disasters. The management can affect the stock,
Yep,
right? If the managers do
absolutely.
something illegal, it certainly takes, or they just make some bad decision, it takes. the
Tweet
company
something
down.
crazy and the stock
up-
drops or goes through.
Come
the
up
roof.
with a new product that's a flop.
Yep.
Or
Yep.
so there's a lot of factors. That's why I didn't like the stocks, because you really have to stay on top of stocks. With options, it's not, because you're doing a short period of time. It's not as critical to have that information. But there was one thing about the options that really turned my interest towards stocks. And when we were learning about options, one of the guys that the instructors said, well, before I tell you, what I always heard was you want to be on the right side of when these bubbles pop, right? We're in a real estate bubble, we're in a money bubble, we're in a debt bubble.
Right.
Everything seemed to be in a bubble. Stock was even in a bubble. So if everything was in a bubble and the economy crashed, these financial gurus, they kept on saying, you want to be on the right side of that so that when the wealth transfers, you're on the receiving end.
Of it, not
Right.
the giving end.
And I always wondered, what is that? Because if everything is in a bubble, where do you go? And that puzzled me for a while, because if I was in real estate, well, should I go to stocks? Well, if I was in stocks, do I go to real estate, or do I go to gold, or do I go to silver?
Silver, right.
So where
Crypto.
right,
Cryptocurrency.
crypto. But everything was in a bubble.
Right.
So where do you go if everything is in bubble? So what this guy said is, and I'm not going to really explain it a whole lot, but he basically said, if you have a put option set up, and there's a strategy that you do this over a long period of time, you're basically buying an insurance policy on the market. So if the market tanks like it did earlier this year in March because of the COVID virus, that market tanked. The people that had this set up as an insurance policy in their portfolio, they were on the right side of that wealth
Right.
transfer.
Right.
And that
Yeah.
what really sold me on
It is
options.
really interesting. It is really interesting that you can turn it into that.
Yeah.
And that's like a 300,
That was a
360 day
huge
kind
swing.
of time frame in
Yeah.
there. expensive, but it's also an insurance policy. Just like
That's
you said.
basically there's different strategies and options, so you can earn money. It goes up, sideways, or down. And there's a strategies for you to have cash flow, and there's a strategy for you to have it so that if the market tanks, you're on the right side of that wealth transfer.
Well, and I know we're going to wrap this up, but I didn't want to just leave out the one thing that I have a dear interest in, and that is cryptocurrency. Mm-hmm. And when you hear cryptocurrency, there's a whole slew of different cryptocurrencies out there, but typically it started with Bitcoin, if you've ever heard of Bitcoin. And there's a lot of people out there saying, "Oh, what is this funny money out there?" I would encourage you, and I think you'd agree now. At one point, you might have said it's funny money.
Yeah.
But I would encourage you to go out there and do some research on Bitcoin and on some of the cryptocurrencies. We're going to do one.
Yeah,
on
we'll do a segment here that'll just be purely on what cryptocurrency is and do a little bit deeper dive. But certainly the way I'm a fan of Robert Kiyosaki, and his thing is for the U.S. dollar, that's government money. Gold and silver, that's God's money, and crypto is people's money, right? So it's
Kiyosaki is the rich dad, poor dad guru.
That's right.
So
Steve, I think this was a good one. So
that's great.
Let's wrap it up, and thank you for. We were doing our cheers first. Thank you for watching. Don't forget to subscribe. If you got a little bit of nuggets out here, put a comment in there. What piece you liked, or what piece you're going to go study a little bit more, and figure out where you can engage in the stock market.
And if you have any questions, go to our website at 2beexceptional.com. That's 2beexceptional.com, and pop us a question. We'll be happy an email. We're happy to answer and have it out there. Of course, comments as well. And we can tell everybody about it. Cheers. We'll see you next time.
Enjoy.